welcome back to this week's market update. Today is Monday, November 24th, 2025, and we will jump right in. It was another soft week for equities as concerns over elevated tech valuations lingered, even as Nvidia reported some pretty standout Q3 earnings last week. Markets also stayed sharply focused on shifting expectations for a potential rate cut, stocks partially rebounding Friday as the futures market started to tilt back towards the odds of having a rate cut in December. We'll take a look at that in a few slides, but as of the close on Friday, November 21st, we had the Nasdaq down 2.74%, and then the Dow and the S&P 500 down pretty close, down a little bit more than 1.9% last week. Moving into our economic data from last week after a long delay from the shutdown, the September jobs report came in stronger than expected with 110,000 jobs added in the month. This was the best pace since the spring, so a pretty strong month of job growth. Most gains came from healthcare, food services, and social assistance, while we saw declines in transportation, warehousing, and federal jobs. The unemployment rate did move up slightly to 4.4% here, but still within a relatively healthy range. Wage growth remained solid, rising 3.8% year over year, so outpacing inflation. One downside, we did get some downward revisions to July and August, but overall, markets focused on the stronger than expected job gains. Moving along in our week, as I mentioned, rate cut expectations were another pretty big part of the market's movements, particularly the rally that we got on Friday. With just 2.5 weeks to go before the last Fed meeting of 2025, markets are being pretty volatile around the futures markets priced in expectations for the potential rate cut in December. So after the stronger than expected jobs report, futures markets leaned heavily towards no rate cut on Thursday. So you can see that in the lighter blue box here, you can see just about a 60% chance of no rate cut as of Thursday. And then on Friday, this quickly shifted as comments from the New York Fed President, John Williams, noting that the labor market weakness now poses a greater risk to the economy than inflation. He also suggested that the Fed might be in a position to continue lowering rates, not directly, but his comments seem to give off that sentiment to the market. And as a result, you can see that the odds of this rate cut, so this is the current level, 3.75 to 4% of interest rates. This is assuming one 25 basis point rate cut. That nearly doubled there to almost 74% on Friday. So completely reversing in just a single day there. You can see the odds of no rate cut sharply declining, the odds of a rate cut sharply increasing on Friday. So interesting stuff as we move towards the last Fed meeting of the year. We also had several really important earnings reports come out last week, including Nvidia, as I mentioned. Nvidia delivered another standout quarter, beating expectations for Q3 and issuing strong fourth quarter guidance, offering clear evidence against those calling for an AI bubble. The stock initially jumped after the news, after market trading, and after hours trading following Wednesday afternoon's report, and pushed higher into Thursday morning. But those gains faded by the end of the week as AI bubble concerns weighed on sentiment. In addition to Nvidia's earnings, Q3 results last week from Target, Walmart, TJX Companies, Home Depot, and Lowe's highlighted a consumer increasingly focused on value. Walmart continued to outperform Target as shoppers gravitated towards lower prices, with Walmart beating expectations and raising guidance, while Target saw revenue decline and reduced its outlook. TJX Companies also benefited from bargain-oriented spending, posting strong results and upbeat full-year guidance. You can see the stock prices. We have TJX Companies up more than 26%, Walmart up 17%, while Target is down 32% year to date. Home improvement retailers were a bit more cautious. Home Depot missed expectations last week, and Lowe's was slightly better, but both lowered guidance due to softer demand for home repairs. So that's one sort of warning spot for the economy there, that consumers are investing less in their homes, maybe pulling back on kind of those larger ticket upgrade items in their homes. But overall, Spending appears to be pretty steady, just a bit more selective, favoring retailers like Walmart and TJX companies that offer value and discounts. Last but not least, delayed by the government shutdown, the August leading economic index showed its largest monthly decline since April, driven by weaker consumer expectations, new orders, building permits, manufacturing hours, and initial claims. On the other hand, these were partially offset by credit conditions and stock prices, but the report still points to a cooling economy and underscores the need to watch the incoming lag data from the federal shutdown in the weeks ahead. So that concludes this week's market update. We really appreciate you tuning in and we wish you a very happy Thanksgiving this week ahead. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.